A guy I went to business school with bought a 3-bedroom house in Austin in 2018, paid $420,000, put down $84,000. 6 years later, that house is worth maybe $450,000. So he made $30,000 in equity after you subtract realtor fees. But here's what happened to his college roommate who didn't buy. The roommate kept that $84,000 in an S&P 500 index fund, added nothing else, and now has $173,000. That's $143,000 opportunity cost for owning the American dream. And we're not even counting the property taxes, the new roof, or the 18 months he spent fixing up the kitchen instead of getting a promotion. Now you might think this is a cherry-picked example. It's not. There's a systematic wealth transfer happening, and the people telling you to buy a house are the exact people who profit when you do. So here's what we're doing. I'm going to explain the actual math behind homeownership, why the incentives are designed to trap you, and the 3 specific wealth building mechanisms you destroy when you buy too early. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Here's the central metaphor I want you to hold. Buying a house is like buying a boat, except you have to sleep on the boat every night, and you can't move the boat. And the boat costs 6 times your annual salary. And if you want to sell the boat, you have to pay someone 6% of the boat's value just to list it. Every financial decision you make for the next 30 years is now downstream of the boat decision. You don't have a boat. The boat has you. Let me tell you about my friend's dad. Guy worked at IBM in the 80s, bought a house in Westchester County for $190,000 in 1987, paid it off over 30 years, sold it in 2017 for $800,000. Everyone in the family talks about what a genius he was. So I did the math with him one night after a few drinks. His total payments, including interest at 9.2%, came to $450,000. Add in property taxes, insurance, and maintenance over 30 years, and he spent roughly $720,000 to make a $610,000 profit. But wait, there's inflation. That $190,000 in 1987 had the buying power of about $480,000 in 2017 dollars. So his real return after inflation was basically zero. A 30-year investment that returned 0% after inflation. And this is the success story they tell at Thanksgiving. Now you're asking yourself, what about rent? Everyone says rent is throwing money away. Let me hit you with the first escalation. Rent isn't throwing money away. Interest is throwing money away. Let's say you buy a $400,000 house with 20% down and get a 7% mortgage. Your monthly payment is $129. But here's the thing, nobody tells you. In year 1, only $629 of that goes to principal. The other one to $1,500 is pure interest. That's $18,000 a year you're handing to a bank, and you will never see that money again. That's rent. You're renting money from the bank, and the rent is $18,000 a year. Meanwhile, the renter who invested his down payment is collecting dividends and capital gains that compound forever. But now you might think, okay, but I get the mortgage interest deduction. Here's where it gets really interesting. The mortgage interest deduction is a subsidy that flows primarily to high-income earners in expensive markets. If you're in the 22% tax bracket and you paid $18,000 in interest, you save $3,009 to $160 on your taxes. Congratulations, your $18,000 interest is now a $14,000 loss instead. You're still losing. And here's the kicker. That tax deduction is literally the government subsidizing banks. You're not getting a gift. You're getting a discount on the tribute you pay to JP Morgan Chase. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Second escalation. Homeownership doesn't just cost you money, it costs you time. And time is the only asset you can't replace. There's a phenomenon I noticed running my business for over a decade. The guys who own houses spent weekends doing yard work, comparing contractors, shopping for ceiling fans at Home Depot. The guys who rented spent weekends learning new skills, networking, building side projects. Over 5 years, That's 500 hours of productive time you traded for the privilege of mowing your own lawn. And you can't get that time back. I've watched talented guys plateau in their careers because they bought a house at 30 and spent their 30s maintaining it instead of taking risks. You know what's harder to do when you own a house? Quit your job to start a business. Move across the country for a better opportunity. Take a 3-month sabbatical to learn a new field. The house doesn't just take your money, it takes your optionality. And optionality, when you're in your 30s and 40s, is the most valuable asset you have. Let me give you a concrete scenario. Meet Alex. He's 34, makes $130,000 a year as a mid-level product manager in Denver. He's got $90,000 in savings. Here are his 2 paths. Path A. He buys a $450,000 house, puts down $90,000, gets a 6.8% mortgage. His monthly payment is $200 to $1,300 to $170, plus $300 in property tax, plus $150 in insurance, plus about $200 a month averaged for maintenance. Total, $3,020 a month. Path B, he rents a similar place for $2,200 a month and invests the down payment plus the monthly difference. Let's run this for 10 years and assume he gets a 3% raise annually and the house appreciates 3% a year, which is the historical average. In Path A, after 10 years, Alex has a house worth $605,000. He owes $268,000 on the mortgage. His equity is $337,000. Sounds great. But he spent $362,000 in total payments over those 10 years. So his net position is negative $25,000 before we even count opportunity cost. In Path B, Alex invested the $90,000 down payment in index funds. Then he invested the difference between his ownership costs and his rent every month, which started at $820 and grew as his rent stayed flat, but his income rose. Assuming an 8% average annual return, which is conservative for the S&P over a decade, his portfolio is now worth $408,000. That's $71,000 more than the homeowner's equity. And it's completely liquid. If Alex wants to move to Austin for a job paying $200,000, he can be there in 3 weeks. The homeowner has to list the house, wait for a buyer, pay 6% to realtors, pay closing costs, hope the market hasn't crashed. The homeowner is trapped. Alex is free. But here's escalation 3, and this is where it gets dark. The entire system is designed to make you buy. Real estate agents make money when you buy. Banks make money when you borrow. Home improvement stores make money when you renovate. Local governments make money from property taxes. Even your parents make money emotionally, because if you buy a house, it means they raised a successful adult. No one in this chain makes money if you rent and invest. So guess what story gets told over and over? Rent is throwing money away. Real estate always goes up. You need to build equity. These aren't facts, they're marketing. I spent years around accountants and fiscal lawyers running my business. And you know what they told me? The wealthy don't buy houses early. They buy cash flow. They buy assets that pay them every month. They buy real estate only when they can buy multiple properties and rent them out for profit, not when they're owner-occupants paying interest to a bank. Here's a story. I know a tax attorney who's worth about $8 million now. He didn't buy a house until he was 43. He rented a modest 2-bedroom and drove a used Camry through his 30s. Everyone thought he was broke. But he was quietly investing 70% of his income into index funds and rental properties he bought with cash in secondary markets. By the time he bought his primary residence, he paid cash, no mortgage, no interest, no bank. And the property taxes and insurance were covered by dividends from his portfolio. That's what ownership looks like when you do it right. You buy the house after you've built the wealth, not instead of building the wealth. Now, to be fair, there are situations where buying makes sense. If you're absolutely certain you'll stay in one place for 10 plus years, if you're buying below market value, if your rent is genuinely more expensive than ownership costs, including true maintenance, or if you have a unique tax situation that makes the deduction actually valuable. But for most ambitious people in their 30s, buying a house is a trap disguised as a milestone. Fourth escalation, and this is the part that made me genuinely angry when I figured it out. Houses aren't even a good inflation hedge. Everyone says real estate protects you from inflation. Look at the data. From 1970 to 2020, the average US home price increased about 5.5% per year. Sounds great until you realize inflation over that same period averaged about 3.8%. Your real return is 1.7% per year. The S&P 500 returned about 10% nominal, or 6.2% real after inflation. You made 1.7, the stock market made 6.2. And the stock market didn't require you to replace a water heater, pay property tax, or spend Saturday mornings edging the lawn. The stock market just sat there and tripled your purchasing power while you were doing literally anything else. And here's the real kicker. When you own a single house, you're making a concentrated, leveraged, undiversified bet on one micro real estate market. If you bought in Detroit in 2006, you lost 70% of your wealth. If you bought in San Francisco in 2021, you're down 15 to 20% right now in early 2026 and paying a 5% plus mortgage. You're not diversified across asset classes. You're not diversified across geographies. You own one house on one street in one city in one economic moment. That's not investing. That's gambling. Lazy investing built more fortune than crypto memes, and houses are just socially acceptable concentrated bets. Let me be clear about what I'm not saying. I'm not saying never buy a house. I'm saying don't buy too early. Don't buy before you've built your investment portfolio. Don't buy before you're certain about your career trajectory. Don't buy because you feel like you're supposed to. And definitely don't buy because a realtor showed you a mortgage calculator that makes it look affordable. Those calculators don't include the new furnace, the HOA fees that double, or the fact that you'll spend $4,000 on a couch because we need to furnish the living room. Here's the part everyone forgets. A house is a liability that you live in. It doesn't produce income. It consumes income. Every month it eats maintenance, insurance, taxes, utilities, repairs. A rental property is an asset because someone else pays those costs and you profit. Your primary residence is a cost center. And if your net worth is under $1 million, you cannot afford to allocate 60 to 70% of it to a cost center. That's financial suicide. Okay, so what do you actually do? 3 things. First, calculate your true cost of ownership. Take the purchase price, add your down payment, add every dollar of interest you'll pay over the life of the loan, add 30 years of property taxes, insurance, and realistic maintenance, which is 1 to 2% of home value per year. Then divide by 30. That's your annual cost. Now compare that to rent plus the compound growth of your invested down payment at 8%. Be honest about the numbers. If ownership genuinely costs less and you're staying 10 plus years, maybe it makes sense. But if the invested alternative wins, rent and invest. Second, build a portfolio first, house second. The rule I use, don't buy a house until your liquid investment portfolio is at least equal to the down payment you'd make. If you're putting down $90,000, you should have another $90,000 in index funds that you're not touching. That way you maintain optionality and liquidity. You're not all in on one asset. Third, ignore everyone who profits from your purchase. Your realtor, your bank, your parents, even your partner if they're romanticizing homeownership. Make the decision based on math and optionality, not emotion and social pressure. Run the numbers in a spreadsheet. Look at the 10-year outcome of both paths. Choose the one that builds more wealth with more freedom. The hook I opened with wasn't a trick. It's the default outcome for millions of people who bought in their early 30s and are now in their early 40s, realizing they'd be wealthier if they just rented and invested. The system told them homeownership was wealth building. The system lied. Homeownership is wealth storage at best and wealth destruction at worst. Wealth building is what happens when you own assets that pay you, compound without effort, and let you move freely when better opportunities appear. And if you bought too early, you've locked yourself out of all 3.